couple of things here. Understanding credit scores, okay? The FICO scores, okay? Understand that FICO has about 550 points. Between 300 and 850 is your credit score, okay? When it comes to your FICO scores, there are different credit scores such as Vantage scores. Like when you go and pull your Credit Karma, quote unquote, Credit Karma, I'm not going to say, some people say, well, that's not a real score. Vantage score is definitely a real score. It's just not widely used within the industry by lenders. Most lenders use FICO scoring models. So tonight, for the sake of that, we're going to talk about FICO scoring models and how it actually works, and then trying to build your credit profile accordingly. Yes, we all understand, quote unquote, 700 should be your thing that you're shooting for. But in actuality, people with a 750 score versus someone with a 660 score, the person for 750 can get turned down, and the person with 650, 660 can get approved depending on their credit profile. That is one of the things that I teach within my digital course and mentorships, and even in my book, I teach credit profile. We're going to build it a little bit here tonight, but not very, very, very in depth, because it's just only so much we can do within an hour's time, okay? So understand this. There are different credit models, okay? Credit scoring models. Okay, there are 28 different scores, okay? If you can't see this, I apologize, but there is FICO 9s, FICO 8s, FICO 5, 4, and 2. For example, when you go to purchase a house and all of a sudden you've been looking at your Credit Karma, which is your Vantage score, which is separate than your FICO, but you go to look at a house and all of a sudden they're looking at, the lender says, well, your credit score isn't high enough. And you're going, wait a minute, I got my score right here on Credit Karma. My Credit Karma score says 700. What are you talking about? But in actuality, your FICO 5 score is 640. Okay, this is why this is vital to understand. When you go to apply with something, you need to know what scoring model are they using. So, for example, if you went to Bank A, they may be using Experian FICO 8. If you go to Bank B or Bank 2, they may be using FICO 9. Or another one may be pulling from Equifax, okay? Another one may be pulling from TransUnion using the FICO 10 model. So it's very vital to understand when you're going to apply for something. The most widely used in lenders, quote unquote, is FICO 8 model. But at the same time, understand if you're going to get something and one bank pulls from Experian and another bank pulls from TransUnion, and maybe your TransUnion score is not that high, but your Experian is 30 or 40 points higher, guess what? Your approval rate is a lot higher with Experian opposed to TransUnion. That's where that is extremely vital in understanding the FICO model, okay? So this right here is extremely vital, okay? I'm sorry. Understanding 35, 30, 15, 10, and 10. And I'm going to show you a model on this next page. This is what you must learn like the back of your hand. Understanding that 35%, so if it's made up of 100%, 35% is your payment history. This is why it's made up. Remember I told you a moment ago, you have 550 points to calculate between 300 and 850. So I'm going to break it down here in just a moment. So what this means is if you have 100 payments that you have available that you've made on a particular item, and you have had 10 late payments, now what that means is you only have 90% of your payments on time. So that's going to lose your points. Your payment history is worth 192.5 points. So if you only got 90% on time, that's going to significantly drop your scoring, okay? That's why 35% is the highest model. What's the next model? This is where many of us get in trouble. And within our mentoring coaching ship, I show you some strategies on how to hide some of this utilization. Utilization or amount owed. What that means is if you have I'm going to change it here. There we go. Your amount owed, okay? The amount owed is worth 164 points. What does that mean? The amount owed simply means if you have a $1,000 credit card, okay, and you owe $800 on that particular credit card. What that simply means to you is now $1,000 is owed. $1,000 available. I'm sorry. You have $800 what owed. So that means you have a 80% utilization. It says here amount owed is worth 30%. The key is you want to always be, you never want to be above 30% of utilization on your credit profile. However, you want to generally be a little less than that. You want to sometimes be at 15%. I like personally at about 9 to 7% is a sweet spot. And actually the FICO scoring model says 7% is the absolute kind of that perfect threshold where you want to be. Now, is there some ways to offset that? Yes, it is. Because the higher you up, the lesser points that you're getting. You want to max out those 164 points, okay? Your credit length. What is credit length? What this simply means is many times student loans can be a huge impact on your credit report. What do I mean? What do you mean my student loans? Corey, I was in school 20 years ago. How in the world student loan going to be something on my credit report? Because it gives you credit length. It's worth 82.5. So that means it's a 20-year-old account. As long as it's in good standing, that then gives you that history that you're needing to continue that long history. In some cases, what if you're just 21 years old, Corey? Well, I don't have any history. I'm going to show you how to get that history at 21 years old here in just a second. So that's what it means by credit length. Again, what am I talking about? 35, 30, 15, 10, and 10. This is what's making your credit score fluctuate up and down, okay? This is vital when understanding how to do things. For an example, if your credit utilization is at, if you have a $1,000 card, for an example, and you put $800 on that card, but your statement date is April the 30th, okay? But your reporting date, is April 30th. Your due date is May 5th. So what does that mean? They reported to your credit report that you owed $800 on that card, but in your mind, you paid that card on May the 5th. So you paid $800. You shouldn't owe anything. That is correct. But what's happening is now it's getting reported on your credit report as 80% versus 0%. Is that going to have a significant difference on your credit score? Absolutely, 100%. Big difference in 80% and 0%. Okay, that's what that is. Let's look over to the next one. New credit. Okay, again, I want to make sure I really classify what I'm saying here. New credit, yes, you get them 55 points. That's great. It's 10% of your score. What this means is if you go out here and get a new credit card or you get a new account, can it give a boost in your credit? Absolutely, it can. If you go out and get 10 new accounts this month, can that have an increase in your credit? No, it will actually act in reverse. It's going to decrease. Why? Because it's only 10% for new. But watch this. What was it for credit length? 15%. So now if you go and add 10 new accounts, what just happened to your credit length? It just went decreased because you just added 10 new accounts. Over a period of time, as those accounts age, will it get better? Yes, but I wanted just to have an understanding there. Credit mix. What is credit mix? Credit mix is simply that. It's to have a certain amount of credit cards, have a certain amount maybe of charge cards, and credit cards and charge cards are a little different, okay? They sound like they sound the same. A charge card, just remember this, such as we used to call them at some of the retail stores charge cards, or Montgomery Ward's, Winkelman's back in the day. If you got some, I'm aging myself here. But American Express has charge cards. What is a charge card? That means you generally have, you can charge that card for a certain amount and you don't have any interest paid, but it must be paid off within that 30-day period. A credit card has a particular limit, meaning $1,000 limit, $5,000 limit, and you can pay over a course, sometimes with interest, sometimes without, depending upon the promotion. But also a credit mix is to have maybe 3 credit cards. Then you also have an auto loan. Then you also have a mortgage loan. It's being diverse and have a really good thing. So take a picture of that real quick here. Okay.